In a lot of times in the past, when you've had these new technologies and excitement about new technologies, you've had bubbles or at least very speculative periods that have resulted in subpar returns for investors.
We focus on the investment lessons from the last 20 tumultuous years.
Funding provided by ClearBridge Investments, the Fairholme Foundation, First Eagle Investments, Bill Miller, Baird, Strategas Asset Management, Research Affiliates, Royce Investment Partners, Seafarer Capital Partners, and Women Investing in Security and Education.
Hello and welcome to this edition of Wealth Track. I'm Consuelo Mack. When Wealth Track started 20 years ago, before the global financial crisis, before COVID, and before 4 presidential elections, the Dow was at around 10,000. It's now closer to 40,000, a nearly threefold increase. The S&P 500 was a little over 1,000. It is now over 5,000, nearly 4 times as much. So think of all of the angst investors went through getting here. Despite recessions, pandemics, and contentious political cycles, long-term investors who stayed invested still came out ahead. In part 2 of our interview with noted strategist and financial thought leader Richard Bernstein, we are going to discuss some lessons investors can learn from the past 20 years and more. Bernstein is the chief executive and chief investment officer of Richard Bernstein Advisors, which he founded in 2009. The firm now oversees or advises nearly $15 billion in assets, largely in multi-asset allocation strategies for financial advisors and institutions using ETFs. In his previous life as Merrill Lynch's longtime chief investment strategist, he was inducted into the Institutional Investors Hall of Fame for his 18-year tenure on its prestigious All-America research team. Now, if you missed part 1 of our interview with him, where he discussed his major investment themes, you can see it on wealthtrack.com. Bernstein is also a student of the markets and investor behavior, and that's where we started our conversation. What did the markets teach us over the last 20 years?
Consuelo, if you think about the last 20 years, we've certainly been through a ton, right? I mean, you've got the hangover from the tech bubble, we had a war, we had the housing crisis, we've had, several presidential elections, all kinds of things going on. The main thing that investors should take away from this is that cycles repeat themselves. Financial and economic cycles repeat themselves. They're never identical, but there are certain relationships that do happen through time. And I think right now, this is a real important point because people think that we're in some period of unprecedented growth or unprecedented lack of growth or unprecedented innovation or unprecedented, my joke has been that we're seeing unprecedented use of the word unprecedented. None of this is true. We have seen all this before. And I think if there's one thing that investors lack, it's a sense of economic and financial history, right? When you start hearing that we've never seen this before, the odds are we have. I think knowing how the market has behaved in those past instances is very important to setting your expectations about the current environment.
I am really reluctant to use the word unprecedented, but people do talk about, remember, the monetary and fiscal stimulus, unprecedented, and which we're still certainly feeling the effects of, and about artificial intelligence, that it's going to change everything. And you and I talked about it in a previous program. So what is it now that is occurring that is a repeat, maybe in a different outfit of what we've seen in the past? What is this like?
So you're absolutely right. Again, let's not use the word unprecedented, but we have seen unusual amounts of monetary and fiscal stimulus. There is no doubt about that, right? We saw a very big fiscal stimulus under President Trump. We saw another 1 or 2 under President Biden. At the same time, because of the pandemic, we saw monetary growth in the United States hit 27%, which at the time rivaled us with Peru. I'm not sure that's something that we should all be bragging about. So yes, there have been unusual amounts of stimulus. And however, the laws of economics have not changed. And so one of the reasons that people have been surprised at how come when the Fed raised the Fed funds rate 525 basis points, we're not seeing an immense weakening of the economy. The answer is because you have these huge monetary and fiscal stimuli before that haven't worked their way through the economy yet. It is unusual to see this amount, but the laws of economics haven't changed. The other thing you mentioned, AI. This is something that we've seen many times in the past. The notion that a new technology is going to change the economy and in doing so presents this massive investment opportunity. The question, will AI change the economy? My answer to that has always been, of course. Like, why would anybody think otherwise? Every major technology changes the economy. There's nothing new about that. The internet changed the economy. The telephone changed the economy. The television changed the economy. The light bulb changed the economy. I mean, there's all these different, and of course, AI will change the economy. We've been there before. But in a lot of times in the past, when you've had these new technologies and excitement about new technologies, you've had bubbles or at least very speculative periods that have resulted in subpar returns for investors. The classic case would be the internet 25 years ago, where the story back then was that the internet was going to change the economy. And it did change the economy in ways that we could never have envisioned. Look at what you and I are doing right now, right? I mean, nobody envisioned this 25 years ago. However, if you bought NASDAQ at the peak of the bubble, it took you 14 years just to break even. If you were smart and you bought NASDAQ a year before the peak of the bubble, it still took you 11 years to break even, right? So we have to separate out the enthusiasm and the hype surrounding the economic possibilities of what's going on with the actual investment opportunity and investment expected returns. And I think right now with AI, we are seeing that similar hype. We think expected returns are much too high for AI type investments. This happened with the internet. It happened with the railroads way back when the railroads were considered technology. This is nothing new that's going on.
And what also isn't new is, again, the cycle. And where are we in the cycle with AI, for instance, and where the market is and how it's valuing this very narrow slice of stocks?
Well, you can see this in the narrow leadership, right? What's commonly called the Magnificent Seven companies, where their valuations are extraordinarily extreme. And the story is that there's something unusual or unique about these companies. The unfortunate reality is that's not true. There are now 160 or 170 companies just in the S&P 500. Forget the rest of the United States. Forget the rest of the world. Just in the S&P 500, there's 160, 170 companies now growing earnings 25% or more.
Wow.
Right? So some of the Magnificent Seven don't grow earnings that fast. The fundamentals don't really support this very narrow leadership that we're seeing, which I would argue is generated by the hype of a new technology, which that type of hype we've seen before, and we've been through this many times in the past.
One of the major investment themes that we've all been taught as a basic fundamental approach is diversification. But when you're in a period like now, again, with this narrow market leadership, it's like, who cares about diversification? Because I'm doing just fine, you know, with this small universe of stocks. So looking back over the last 20 years, has diversification really paid off? Is that still something that the market is teaching us?
Yeah, I think it has. I think there's this notion that diversification is kind of a free lunch, and I would disagree with that. I think diversification is an insurance policy, and it's an insurance policy against you being wrong, that your view of the world turns out to be incorrect. And so, if you say, why are people habitually under-diversified, it's because people don't like holding something in their portfolio they don't like. I'm doing great in these 7 stocks. Why would I do? Well, what if the 7 stocks start underperforming? What do you do then? You always have to have something in your portfolio that doesn't match your view of the world. That's what diversification is all about. People confuse the number of asset classes with diversification. Now, I have stocks, I have bonds, I have real estate, I have, alternatives, I have all these different things. I'm well diversified. But if you like them all, you're probably not well diversified. There should be something in there that protects you in case you're wrong. if your view of the world turns out to be wrong. That's what diversification is all about. Does that work? Yes, it does. It always has. The problem is that people don't like to accept the lower returns. In other words, paying the premium on that insurance policy, right? There's no insurance for free. They don't like getting lower returns. And when you're in a period where you have the Mag 7 and returns are ripping, the notion of diversification becomes so distasteful that people don't diversify anymore. They put all their eggs not into one basket, they put all their eggs now into 7 stocks, which intuitively should sound dangerous to people, and I would argue it probably is.
Extending time horizons are critical to building wealth. That was one of your recent reports. Talk about time horizons and why they make such a big difference.
Right. So, Consuelo, I'm smiling and laughing a little bit because there are these little things that people can do that make building wealth so much easier through time. And the data show very clearly that extending your time horizon reduces the probability of losing money. Literally, as you go from 1 day to 1 week to 1 month to 1 quarter to 1 year to 3 years to 5 years to 10 years, your probability of losing money goes down. In a 1 day time frame, you're basically flipping a coin because the economy doesn't change in a day, right? Companies really don't change in a day. It's all noise that you're trading around. But as you extend your time horizon, you're actually beginning to invest for fundamentals. We think that's critically important, and the data show that for not only just for stocks, but even for fixed income, for emerging markets, for U.S. stocks are saying, but for emerging markets, all these different kind of asset classes and sub-asset classes, extending your time horizon is one of the easiest things to do. I don't understand why people trade frequently. I think they should invest and then go play golf and just have a better life. I mean, why are you in your basement trading stocks? You're not going to help your performance through time. That's what the data shows. And you're probably not as physically fit as if you were out playing golf or cycling or doing something.
You wrote a book, Rich, in 2001 that you updated in 2005 called Navigate the Noise, Investing in the New Age of Media Hype. That was so prescient. I mean, it's just gotten so much worse. How does one navigate the noise?
What the book tried to focus on way back when was the basic rules of building wealth, and they're not very difficult, so why don't people do it? And the answer is there's always kind of a siren song telling them there's something new and better and exciting and you have to do this, and you continuing on the Greek mythology, and then the portfolio crashes on the rocks. That's kind of what happens. And so, but why does that happen? Why is there always this siren song? How do you get rid of it? And so, I think in mythology they put wax in their ears, and so they didn't listen to the siren song. And that's right. Kind of what the book suggests is, there are simple things that we can all do. Extending your time horizon, compounding your dividends, realizing that cycles repeat and we're not on some new age or where there's nothing new that's going on. And the book kind of goes through that and just says, do these simple things versus where we were 15 or 20 years ago. As you correctly point out, media has mushroomed. Financial media has absolutely mushroomed. I just think people should really ignore most of what goes on, realizing that the economy doesn't change dramatically in a day, let alone in 10 minutes. Right? The economy is not going to change by the next commercial break. I promise you that. And that's the kind of stuff that people should wean themselves off of. Of course, Consuelo, not when I'm on TV, but when everybody else is on TV, they should ignore it.
No question about that, yeah. Rich. If you hadn't said that, right. I would have. But navigating the noise, there are sounds that you do pay attention to. Mm-hmm. What are some of the things I'm thinking over the last 20 years that you really needed to pay attention to? And yes. Certainly what the Fed was doing, what the Treasury was doing, what the federal government was doing that made a huge difference in the markets.
So, Consuelo, I would say there are a couple of things that are kind of basic things that people should pay attention to. Number one, given where we are in the political cycle, I don't think people should pay attention to the presidential election. I hate to say that. I don't think it's very worthwhile. The reason I say that is in my 40-odd year career, the losing side of a presidential election always says the market's going down. Never fails. So for me, the first one would have been Ronald Reagan and Jimmy Carter. Ronald Reagan wins, we have a bull market. Then we get to Bill Clinton, we have a bull market, right? We get to George Bush the second time, well, okay, maybe we had the lost decade. Okay, maybe that doesn't fit all that well. We get to Barack Obama, we have a bull market, right? We get to Trump, we get a bull market. We get to Biden, we have a bull market. I mean, I think people get too wound up about this. So one of the things I suggest people do not listen to is the political aura that goes on, the noise around politics. It's fun, it's interesting, I get it, but I don't think it's going to help your portfolio. The other thing I would suggest that people do look at are leading indicators of the economy. Now, this is a little bit subtle, and I apologize for that, but there are leading, coincident, and lagging indicators of the economy. Leading indicators, as the name implies, lead the economic cycle. Coincident, move with the economic cycle. Lagging, move after the cycle has moved. Investors should always look at leading indicators. The stock market itself is a leading indicator. I've always been fascinated that investors tend to focus on lagging indicators. What are lagging indicators? Inflation, unemployment. The Fed itself is a lagging indicator historically, right? What are leading indicators? Well, people are going to laugh. They're not going to know any of these things. Weekly initial jobless claims, building permits, right? I mean, things that kind of lead the economy. So that's number one. I would say you have to focus on leading indicators. Second thing I would say is an investor should focus on profit cycles and not economic cycles. You hear tons about the economic cycle, but really don't hear very much about profit cycle. And if you're an equity investor, profits are much more important than GDP, right? Let's remember what equity investing is all about. Equity is about becoming a partial owner of a company. And as you become a partial owner of a company, all you care about is the profitability of the company that you own, right? You don't really care about GDP. GDP may help your corporate profits, but it may not. So the profit cycle is actually what drives things like growth and value, large and small, quality, sector rotation strategies. All those type of things follow the profit cycle, not really the economic cycle. So I would say ignore politics, look at leading indicators, and look at corporate profits.
What are leading indicators telling you now?
Leading indicators are actually more optimistic than most people are right now, surprisingly enough. There's several measures of leading indicators. They've all troughed. They're not showing immense strength in the economy, but they're all hinting at improvement in the economy, which is very interesting given that most people think we're on the precipice of a recession or something worse.
Where are we in the profit cycle?
Profit cycle, I actually think people should be very optimistic about. You know, in 2023, corporate profits in the United States were down about 10 to 15%. It's our forecast by the end of this year, S&P 500 corporate profits will be up 10 to 15%. Small cap profits may be up a multiple of that, and emerging markets are probably up maybe double what the U.S. corporate profits growth will be by the end of this year, early next year. So not only in the United States, but the global profit cycle is starting to accelerate. And I think that's great news. That's good for cyclical stocks. It's good for employment, right? It's good for a lot of different things.
And I think that you told me that the opportunity set is the broadest it's been in our lifetimes.
In a generation, for sure.
In a generation.
If you think of the markets as a seesaw, and normally this doesn't matter. You don't have to think of the market as a seesaw, but the market has become so, what people like to call bifurcated. We've got these 7 stocks, and then we've got everything else in the world. The 7 stocks are so dominating the indices and dominating the overall market that the opportunity set in everything else is like historically broad and historically attractive. And so this does not happen very often. And the way that I think your viewers should think about this, are there really only 7 growth stories in the entire global equity market, right? Of course not. There are tons of growth stories out there, but nobody's interested. That, from our perspective, presents tremendous opportunities. And that's where our portfolios are focused, right? Our investors don't necessarily want us to follow 7 stocks. We're not momentum investors. But this other side of the seesaw, people have virtually no exposure to. It's an amazing opportunity.
Rich, why ETFs? Why did you decide that those would be the vehicles of choice for your asset allocation strategies?
We are what's commonly called a macro firm. In English, that means we know nothing about Coke versus Pepsi, Merck versus Pfizer, anything like that. We have no insight. no expertise in that. So as macro investors, ETFs allow us to buy baskets of stocks, if you will, to fit the allocations that we want. They're very, very inexpensive. They are very liquid, both equity and fixed income, and even some commodity ETFs that are structured properly, allow us tremendous flexibility in a short period of time. That's not only true on the equity side, we tend to think, but the fixed income side, ETFs on the fixed income market are growing very rapidly and are bringing liquidity to what's historically been a tremendously illiquid market.
Speaking of the fixed income market, I mean, the last 20 years, it's just been a sea change. We had a 40-year bull market in the bond market, and it's just totally reversed. And, worst bond market ever in 2022.
Yep.
How does one navigate that? What is your view of bonds now?
Right. Fixed income investors had it pretty easy for a long time. We were in a period of secular disinflation, secularly falling interest rates. It was really easy, right? I mean, let's be honest here. Probably the worst fixed income investor probably got great returns, right? We think that's over. And we think the reason that's over is because of deglobalization, right? The globalization opened markets, consistently increased competition, which puts downward pressure on prices, which we call secular disinflation, which resulted in secularly falling interest rates. It was all great. Well, now globalization is starting to contract. And as it contracts, we will reduce competition. And as you reduce competition, you get upward pressure on prices, not downward pressure on prices. So we think fixed income investing will be more challenged because we're going to see secular inflation instead of secular disinflation. That will mean you'll have to be more tactical, but we think our use of ETFs allows us to be, tactical.
And what role does fixed income play in a portfolio now? It used to be income, which you've got now, but it also used to be stability.
That's an interesting question because, and what you're alluding to is the fixed income volatility has gone up. For a long time, fixed income volatility was declining. Now it's going up. I think that as a diversifying element, things like treasuries and high quality governments and things like that will remain diversifiers, right? In other words, when corporate profits go down, when the stock market goes down, I think you'll find that high quality fixed income will still be the diversifier. The problem is, and the difference is that when earnings are revving up and when the economy is getting stronger, interest rates are going to go up now. So you won't get the situation where both stocks and bonds are appreciating at the same time.
We've talked about the importance of diversification in a portfolio. We've talked about the importance of thinking long-term, investing long-term, which leads me, ta-da, to the question, what is your one investment recommendation for a long-term diversified portfolio?
We spoke before, Consuelo, about how the opportunity set on this other side of the seesaw is so broad and huge. So I don't think people have to get too sexy on this one, and you don't have to be, overly thoughtful. You want to buy something on the other side of that seesaw. So it could be small caps, it could be emerging markets. My personal preference would be U.S. mid caps and small caps. I think they will do very well in an environment of shrinking globalization.
And final question, Rich, is in the ETF world, in January, we just had the launch of 11 spot Bitcoin ETFs. Talk about diversification, talk about maybe being extremely uncomfortable with that as an investment. What is your thought about Bitcoin ETFs?
Consuelo, I am somewhat notorious among the cryptocurrency crowd for being very anti-cryptocurrency, very anti-Bitcoin. Some people say that Bitcoin is a currency. I would point out, if that's true, it will be the first currency in human history that will be traded and speculated first before it has an economic purpose. Bitcoin serves no legal purpose right now. I think this is really speculation. I think it's hype.
All right, and pure speculation does not fit into your definition of a good diversifier.
Not at all.
Rich Bernstein, what a treat to have you on Wealth Track again, and congratulations on the 15th anniversary
Thank you.
Of Richard Bernstein Advisors.
Thank you so much.
At the close of every Wealth Track, we try to give you one suggestion to help you build and protect your wealth over the long term. This week's action point is read Stocks for the Long Run. The Definitive Guide to Financial Market Returns and Long-Term Investment Strategies by Jeremy Siegel. Now, this is an investment classic that has been updated several times. It was named one of the 10 best investment books of all time by both the Washington Post and Business Week and has been a perennial bestseller. Siegel, who is a professor emeritus of finance at the Wharton School, is a financial thought leader on the markets. His optimism about owning stocks for the long run has been borne out over time. He was an early guest on Wealth Track, and I look forward to inviting him back again. Next week, how Bitcoin has gone mainstream with cryptocurrency expert Matt Hogan, the chief investment officer of Bitwise, which just launched its Bitcoin ETF in January. In this week's extra feature, Rich Bernstein shares his must-read recommendation with us. Please follow us on Facebook, X, and our YouTube channel. Thanks for watching. Have a great weekend and make the week ahead a healthy, profitable, and productive one.